Good afternoon, everyone. Welcome to our MQ Traders webinar on the topic how to use hedging to maximize your potential profits. I'm Robin, the host for today's event, and I'm one of the MQ Trader team member. So before we get started, can I have a quick mic check first? So if my voice is loud and clear, can you guys please type one in the chat box to let me know? So if you can hear my voice, can you guys type one in the chat box to let me know? Okay, Stanley. So, and once again, remember to log into your MQ account first so that you can chat with us inside the chat box. So once again, MQ Trader stands for Malaysia's Quantitative Trader Group. We are a group of traders that uses quantitative methods to do stock analysis, and then we have developed the MQ Trader Stock Analysis tool. So in this tool, we will bring what normally only available to large financial institutions to our MQ members for free, as our goal is to empower our traders so that they can make quicker decisions with greater confidence during their stock trading journey. So other than the stock analysis tool, with MQ Trader, you can also use these services as shown on the screen. So for example, like you can accumulate our MQ points whenever you trade, then you can actually use those points to redeem attractive rewards like cash vouchers. Then we also have the MQ affiliate program where you can get repetitive rewards by referring people to our selected advertiser. We also have MQ Dummy, the current platform that we are using for the webinar. And also, so in this platform, you can join various trading and financial knowledge webinars as well. And the best part is most of them are free. And we'll also update various finance related events in our MQ event website. So remember to check it out so that you won't miss out on any finance related events. So if you're interested in any of the services that I mentioned just now, you can scan the QR code or find the links in our chat box to learn more. Now, to get all these benefits for free, you can open a free trading account with our selected advertisers. So currently, we also have an additional account opening rewards for you. So other than our subscription services, you can also enjoy like free account opening, free premium t-shirt after you perform 5 trades, and free share transfer in, and also free i3 investor portfolio integration. So if you are interested, you can scan the QR code on the screen for the respective advertiser to submit your basic contact details. Then afterwards, the team will contact you to guide you on account opening process. And for MQ members, as usual, you can get a bonus of 300 MQ points as check-in rewards. So it's quite simple, only 3 steps. First step, screenshot any part of this webinar. Second step, find our quiz email, which you will receive after the webinar ends. Third step, complete the simple quiz and then upload the screenshot of webinar to claim your 300 MQ points. I remember if you want to get a quiz email, you have to register for the webinar first. So for those of you who haven't registered, you can scan the QR code or find the links in our chat box to register and get our quiz email. So today's webinar is sponsored by VC Plus. VC Plus is a global online trading platform. They provide global stock index options, foreign exchange options, commodity options, and etc. And they also support various payment methods and is registered with authorities around the world. And the account opening is free and totally online to trade. This is part of the VC Plus system. They have this chart system in their trading platform itself. So in this chart system, you can find buy and sell signals in just one click. And you can also do a live back testing to test whether these buy signals have a high accuracy in successing. And right now, VC Plus has a $100 welcome credit campaign. So basically, you just open a trading account, deposit $500, and then you can get the $100 for free. Of course, terms and condition applies. And the campaign ends on 30th June, which means that it ends in 3 days. So remember to sign up now if you want to redeem this $100 for free. You can always contact them or scan the QR code to learn more. And VC Plus is also running a trading contest ending by 30th June as well. So if you are confident with your trading strategy, remember that you can join in and you may still get a chance to win their attractive rewards. The highest price goes up to $1,000. So if you are interested, remember to sign up for a VC Plus account and get it verified to prepare for the contest. The best part is the contest will be done in a virtual account, which means that you no need to use any of cash. You can use fake credits to participate in it. So for more terms and conditions, you can PM VC Plus support team to know more. You can also join their group chat in the MQ chat system to get daily market updates for free. Just scan the QR code here and message them at me, and the respective team will add you to the group chat. So we are going to have a Q&A session after Kayong sharing, followed by a mysterious gift session. So in the mysterious gift session, we'll be giving gifts worth up to 249 ringgit. So make sure if you want to win this attractive 249 ringgit gift, stay until the end to get your chance to win it. So for our speaker today is Mr. Kayong. He started trading with just $500 when he was only 21 years old, and managed to turn it to 13,000 US dollars within just 2 years of time. So with this success, he was then featured on Singapore CNA Money Mind Young Investor when he was only 23 years old. Along the way, he was also awarded the most popular FX trainers in Malaysia and top forex analyst in Asia. Currently, he is a market analyst on various platforms and the head coach at eSmart Academy. So the topic that he'll be sharing with us today is about understanding the concept of hedging, identifying what are the suitable hedging instruments, and most importantly, how to implement an effective hedging strategy. So after all this introduction, can I check if all of you are ready for Kayong sharing? So if you are ready, please type one in the chat box to let us know that you are ready for it. So remember that you need to log in your MQID in order to chat with us. So Kit, I saw you type one in the chat box. Okay, so since everyone is ready, without further ado, I would like to invite Kayong to share with us now.
All right. Okay. Quick mic check. Are you guys able to hear me? If you can hear me, just type OK, and then we'll get started. Okay. Good. Okay. Let me just. Wait. I think my screen is not sharing. Just check because my site is not working. Are you guys able to see my screen? Basically, you should be able to see the PowerPoint slides. Can? Cannot. All right. Okay, give me a while. Okay, I'll refresh and I'll come back in. I think just now it was fine then. Okay. Okay, should be fine now. Okay, good. All right, so we'll get started for today's session over here. Okay, so basically today I'll be sharing with you a little bit more into the concept of hedging. Some of you who are perhaps a little bit more experienced may have come across this concept before. So if you have, then hopefully what I've prepared is able to also give you more ideas and insights into it. But for those of you who maybe have yet to experience what hedging is or haven't come across the concept of hedging, then today's session is going to give you an idea, okay, how you can actually use this management technique to actually approach the financial market, right? Whether you are trading in terms of stocks, whether you are trading in terms of like FX, you can actually implement the concept of hedging to help you control the downside and potentially maximize the profits, right? That's the idea of it. So very quick, I think I'll just skip through this part. Just a very quick introduction about myself. So I skip through that. But I think more importantly is this slide here. I just want to cover very quickly is that there are generally quite a bit of fake accounts out there, kind of on Facebook, on Telegram, on Instagram, and whenever you receive, a message on either of all these social platforms, asking you, about your trading, asking you to transfer any kind of like funds or cryptocurrencies, just be very very careful, okay, because most likely they are all fake accounts, right? Because I don't do that. So if you can't see like any of the account using my photos or my name, just be very, very careful on that. All right. So today's conversation and presentation over here will be talking about what is hedging, right? To give you an idea what basically this concept is, we'll talk about how you can identify suitable hedging instrument. Okay, this is because some of you are probably into like options, into US stocks, or even let's say in the FX market, like what I do. Right, you'll be able to then identify what are the methods that may suit the instruments that you would like to hedge, right? I think one of the challenge is, of course, if you're doing Malaysia stocks, there are certain limitation in terms of how you can hedge it internally. But you can always, still implement a little bit of this concept here, and you probably need to do a bit more research into like specifically for the Malaysia stocks, local stocks, how you can actually do hedging, right? But beyond that, if you are looking at US stocks, you are looking at indices, you are looking at currency markets, hedging is fairly straightforward, right? Because it's very accessible. Then I'll share with you an example in the FX market, okay, how we can actually implement a effective hedging strategy to kind of maximize the profit potential, okay, while kind of controlling our drawdown, controlling our risk. Okay. So good. Let's start off with first understanding what exactly hedging means, right? Because I think you may have an impression of what it is, but let me kind of like put it out here so that everyone have a common understanding of what the hedging concept really is. Okay. So hedging itself is basically a risk management strategy. Okay, it's not a trading strategy. It's not an investment strategy. It's a management strategy. Okay, in other words, you can't just use hedging to enter and exit the market. Okay, it's basically a management technique, which means you need to have your individual existing kind of like trading or investment strategy. Then you use hedging as part of your management. Okay, so itself is a risk management strategy to help you, as I mentioned, right, protect yourself against the downside. Or some traders and investors will use it to mitigate or lower the volatility of their entire portfolio. Okay, so this is something that you need to understand first, right? This is very important because a lot of times people might think that, oh, I just use hedging as a strategy to trade and invest. You can't, right? You need to at least have a entry technique and exit technique, and then you complement it with hedging to manage the positions in your portfolio. Okay, so hedging involves taking some of the opposite direction or using some other different forms of instruments that have what we call an inverse relationship. Okay, so to give you a very simple example, okay, for example, we know that if I use stocks, right, let's say we use S&P and maybe the Nasdaq. Okay, now this is not the best example, but I think this can relate to most of you. Now, S&P and Nasdaq, they're generally the US market. Okay. So what it means is that if today you are very, very bullish in the tech sector, right? So Nasdaq is more heavy on tech. Okay. So what you can do is you can then buy the Nasdaq. But in the event that the equities market doesn't do well, okay, what happens if suddenly there's something happen and then general equity starts to drop? So you can actually sell the S&P while buying the Nasdaq, and you realize that these two have some kind of relationship, and you basically hedge it. Okay, because if the tech sector perform very well, you may suffer some losses in the S&P position, okay, but your Nasdaq position is going to perform way better, and you're going to make that profit to cover your position on S&P. Now, you may not make as much, but you'll be able to limit your downside or your volatility in the event the equities market actually drop. Okay, so this is actually just using like very, very basic understanding and similar kind of financial instruments to hedge it. Okay, now there are more complex stuff where you can use options, derivative to do it. Okay, but I just want to give you an example very quickly over here as to what hedging really means. Okay, so the goal as a primary function of hedging is not necessarily to like guarantee you profits, right? I think you guys would know there's no such thing in the market. But hedging essentially is to, as I always highlight, right, is to actually first protect your downside. And because of that, okay, you can potentially then take it further and maximize your profit potential. Okay, so don't approach hedging in the terms of like, well, I don't take losses, and it's a guaranteed win, right? That mindset and understanding is wrong. It's not accurate. Okay, hedging is first to protect the downside, and then because you're able to protect your downside, you're then able to maximize your profit. Okay, so that's the whole idea of hedging, right? Now, there are different types, as I mentioned. Okay, one is you can actually use future contracts. Some of this method may be a little bit more advanced, because you need to then understand, like, if you're using future contracts, you need to understand the futures market. Okay, if you're using options to hedge, you need to understand the options market. Now, future contracts is quite straightforward. Okay, the whole idea of future contract is you have an expiry date. Okay, and this one here, as traders, we seldom use futures contract to do hedging. But if today, you're running a business in terms of like commodity space, they will naturally use the futures contract to hedge it. Okay. So for example, if give you an idea, right? For example, today you are producing, let's say, crude oil. Okay. And then of course, as a producer of crude oil, if prices of crude oils goes up, your business do well, right? Because you are able to sell it at a higher price, you make more margin, your profit increases. But if today you're producing crude oil and let's say in the future, down the road, maybe 3 months down the road, crude oil prices drop, then you as a business producing crude oil would suffer, right? So how do you hedge against the volatility of the market price? You actually can go over to the futures market and open the sell position in the futures. Okay. So as a business, I produce crude oil, physical crude oil, but I can go to the futures market and sell it. So if let's say down the road 3 months, right, when I produce crude oil and then the market price of crude oil has dropped, so I actually suffer some losses in my business point of view, but because I've shorting the futures contract, I actually profit from that price drop. So net, I kind of mitigate this kind of market volatility price point. Okay, so this is something of a concept of hedging, right? So a lot of commodities businesses are utilizing hedging to kind of protect themselves in this industry. Now, just like I mentioned options, right? So options is actually another second way in which you can do hedging. This is very, very common for stocks investors, or even sometimes stocks traders, right? In the US, right? Because Malaysia, sadly, we don't have options market. So give you an example of how options contract can be used to hedge for longer term investor. Now, longer term investors generally they are very, very bullish, right? Because you don't sell a stock for the long run. Okay, you would buy a stock for the long run because you have done your work. This company is solid. You would like to invest in it for the long run. But then investors, as us, we understand that there's short term volatility. Okay, the market is never gonna keep going up, right? Some days, some years, it's gonna come down like what happened in last few years. So what you can do is, for example, I'm very, very bullish in, for example, Apple stocks. Okay, you can go niche specific stocks in the options market. You can also go in terms of indices like S&P, right? But give you an example, right? Today I'm very, very confident in Apple stocks. Okay, but at the same time, I understand that we may transit into a bear market, or at certain months the stock will drop. Okay, so what I can do is I can buy the underlying asset, which means I buy Apple physical stocks, right? I use cash to really get involved in it, right? To buy Apple. So I accumulate some Apple shares and I can then use the options market, okay, to kind of go against my buy shares in Apple. Okay, so in the event where Apple shares drop, I can actually make money out of my options contract. Hey, while my portfolio is falling, I can actually make money out of my options market, and then get involved maybe at a better price using the profits that I made again, to accumulate my positions in Apple. Okay. So as a long-term investment approach of hedging, using options is actually a very, very solid plan. Again, if you understand options market, today if you write options, you sell options, you also collect premium. Okay, so that's very, very it's kind of advanced technique to approach it, but it carries an element of hedging. Okay, so that's something for you to understand as well. Give you some ideas. If you're into that, you can start exploring a little bit more about options market. Now, then of course, the other type of hedging is called diversification. I think this is fairly easy for many people to understand because you might heard of diversifying your portfolio, from different people anyway, right? So example of diversification is, for example, today you have 100,000, in terms of net asset. You don't want to put 100,000 all into one or two stocks, right? You want to diversify it, right? And again, in terms of diversification, you need to look into industry diversification, sector diversification, etc. Okay, so for example, if you buy into recently the chips and AI stocks, if you buy into Nvidia, you buy into AMD, you're literally investing these two positions in the same industry and the same sector, right? So that's not diversification. Okay, so diversification can be a portion of your portfolio into technology, a portion of portfolio into maybe utility, a portion of portfolio into healthcare, right? So that's some form of a diversification. Now, diversification also can be stretched into like various forms of asset, right? You can be diversifying a portion of your portfolio into equities, into stocks, then a portion into maybe bonds, a portion into commodities, etc. Okay. So this one I think is quite straightforward. The understanding of like using diversification to hedge out your risk. Okay. And then of course you have the buy and sell hedge. This one is a little bit more specific to, I would say, the FX market. Okay, so a buy and sell hedge essentially is, give you an example first for now. You get involved in a buy trade, okay, and if let's say the price point doesn't go up, right, it go against your buy position, what you can then do is you can initiate a sell position to lock in your floating drawdown. Okay, so when you have a buy and sell hedge, doesn't matter what the market do, your risk maintains control. Okay, so that's what we call a buy and sell hedge, right? So each of these types would be designed specifically depending on, are you looking at the stock market, are you looking at a long-term investment portfolio, or are you looking at maybe some shorter term trading? Okay, depending on all this, you may use different types of hedging. Okay, so of course for me, my focus for today, as we progress, I'm going to give you some example at the end. It's going to be more into the buy and sell hedge technique, right? Because that's where I apply into the FX market. Okay, so quick one, benefits of hedging. Okay, as I have been stressing this, is all about reducing your downside risk. Okay, that's your first benefit. Okay, and then of course some traders will be able to use it to protect its profit. Now, give you an example of protecting profits, right? Is that you don't immediately initiate a hedge when you execute a position. Okay. If you want to use hedging to protect your profits, what you then do is you execute a position. It goes in your favor. For example, you buy Apple stocks, right? It has rallied 50% based on whatever margin you put it. So you are in good profits, right? And let's say today you want to keep holding. You don't want to exit that position if the price just drop, but you want to protect the profits, right? So you expect a bit of a pullback. Now, what you can do is instead of exit the position, you can use the options market to actually put in a position, and if price drops, you make money out of the options market. Okay, so this is a technique that you can use, very specific in the stock market, to protect the profits while still holding on to the position for the long run. Okay. Of course, it also provides stability because it reduces the volatility. This is more specific if you're going to use it for diversification. Okay. So understanding a little bit about what hedging is, the concept of hedging, then the next step is, of course, if today you want to do hedging, right, you need to identify suitable instruments to actually do it. You can't just apply it to, everything. You can't, like as I mentioned, right? So the market doesn't have options. So the market doesn't have futures assets, right? You can't do a simple buy and sell hedge management technique for all types of instruments. Okay, so you need to first identify what is your primary goal, and then identify the suitable instruments to actually use it. Okay, so first, hedging doesn't remove risk. Okay, so you still need to understand that there's still risk involved, but it helps to kind of reduce it. Right, so it's important to still evaluate, right? In terms of like today, certain asset they are trading, what is the downside risk? Okay, it's very very different. For example, if today you look into general S&P indices, okay, versus another asset like maybe Bitcoin, okay, their individual specific risk is very very different, right? Because we know, and I would say, okay, we are definitely more comfortable and confident that S&P in the long run is going to be bullish. Bitcoin in the long run is uncertain. You may say that it may stay in the market already, but whether Bitcoin is going to keep going up in the long run, where we talk about like 5 years, 10 years, you may still not be as confident as compared to maybe the S&P market. Okay, so each asset has its own specific risk, right? And the more volatile an asset is, the riskier an asset is, the management technique of hedging is going to be very, very different from something that is safer. Okay, so that's the understanding of each individual asset, right? Very, very important. So certain things that you may want to consider is also, in terms of volatility, changes, currency fluctuation, commodity prices. There are certain factors you need to also understand and be aware of. Okay, so for example, interest rate changes, right, or fundamental changes, right? Over here, when I talk about interest rate, it's more specific to FX fundamentals. But if you're looking at stock market, okay, the fundamentals are important as well, right? For example, today you invest in company A. The initial philosophy and reason for you to invest into it is because maybe the company is has a huge growth potential. Okay, so it may not be a value stock yet, but it's a growth stock. It has huge growth potential. Then maybe you started investing into it, and then 2 years down the road, the price doesn't really go. Okay, the price doesn't move, and maybe there's some changes in fundamental, right? The growth potential is not as great already, and things like that. So you need to also take into account all these things, right? It's not like I buy into it and then if it goes against me, I just hedge, right? No. Sometimes you still need to consider if things is no longer aligned with your initial idea, okay, you still want to cut it out. Okay. So hedging is not a sure win thing. Okay. Hedging, again, you need to have the very right understanding mindset. Okay. So this is something I want to highlight and stress upon so that you understand it, right? The fundamentals and the principles in which you actually initiate a position needs to still be the one that drives your decision-making process. Okay, so I hope that clarifies and is important. Okay, so you want to then look at the potential risk and the impact of all these assets that you're looking into. Hey, for example, yeah, again, another one here is if today you're looking at indices. Okay, I mean, in the US generally, okay, if the Fed raise rates, the equities are not going to do well. If the Fed cuts rate, the equities are generally going to do well. Okay, so in the context of where we are today, the Fed has actually indicated that potentially they're going to hike it maybe 2 more times. And we know quite confidently, all right, I would say 99%, that the Fed will eventually cut rate. Okay, it's just a matter of time, right? Is it going to be end of this year? Is it going to be mid of next year, or is it going to be end of next year? But generally, I would say 99% of the time, I'm confident that the Fed will eventually cut rate. Okay, so if I'm putting this perspective into, let's say, I want to invest in the S&P. Okay, it's quite straightforward, right? I don't need to time when I get in. Okay, if I'm looking at a long run, right? Because I know eventually from now onwards, maybe we see another 2 hike, and then after that, we're gonna start cutting, and it's gonna be beneficial for the S&P market. So what I can do is instead of timing the market, right, I can actually access all this information. Okay, understand market volatility, understand interest rates, understand how it can affect the in terms of equities market. I can say, okay, let's buy the S&P now. Okay, but understand that as we are looking at potentially 2 more hikes, the S&P may continue to maybe pull back or drop a little bit, right? Then I can actually deploy a hedging technique and say that, okay, I'm also going to look into like writing a options position, right? So if the market keeps dropping, I may benefit from that while I buy onto actual S&P contracts, right? And when it drops, right, I make that profit from it, and then I do a thing called a dollar cost average, right, or DCA. So I kind of have a general sense of direction. I have a trade idea. I have a certain philosophy as to, or thesis, investment thesis as to why I'm looking to buy into S&P. Okay, and then I just use an alternative kind of metric to hedge that position in the event that in the short run it go against me. Okay, so this is an example. okay, which you can see, right? Again, different asset, different reason where you execute a trade or investment idea. You need to actually cater for that. Okay, so that's the idea behind it. Okay, so matching hedging instruments, right? So the idea again, as I mentioned, once you identify like what's your TCs, what are the instruments that you're trading or investing in, you need to choose the appropriate one. Okay, because sometimes if you don't understand certain derivatives, um, instead of cutting the risk or lowering the risk, you increase the risk. Okay, so you definitely need to get yourself exposed to the understanding of different derivatives, right? The risk involved, the benefits of it, and then how then you can use those as potential hedging instruments. Okay, so give you some basic understanding of it, right? If today you want to mitigate or lower the risk, which is in terms of price volatility and price fluctuations, then you can actually use future contracts, right? The whole idea of future contracts is you can look into shorter term futures like 3 months, a month into the future, right? You can have also long term future contracts like 6 months down the road, 1 year down the road. Okay. Of course, the shorter the period in terms of your futures contracts, the more volatile it's going to be. The longer term your future contract is, the less volatile price is going to be. Okay, so this one here, as I mentioned just now at the start, I give you an example, is more towards people who are doing business. They're going to use futures contract to hedge against their business volatility. Okay, as traders, we seldom do that, right? As traders, if you're into the stock market, options becomes a very, very common hedge, right? Now, options were designed primarily not, if you look back into options narrative, how it's being created and things like that, it's not designed primarily to actually make money. Okay, but of course, in today's context, a lot of traders purely trade options for profits. But options is actually very designed to actually hedge. Okay, so options is not so straightforward. Options, there's buy options, there's sell options. There's call options, there's put options. If you want to explore into this, my suggestion is always go and study a little bit into the options market. Okay, there are very specific strategies on how you can execute options as well. Okay, there are more things you need to consider as compared to an individual trade itself. Because if today you want to profit from a trade, you just need to get two things right: the direction right and the timing right. In the options market, other than the direction and the timing, you also need to understand volatility. Okay, because volatility in the market can affect option prices. So if you're trading options by itself, you need to consider these three things. But if you're using options to hedge, then it becomes less complex, okay, because you already have an underlying asset. You already have, let's say, for example, you have a buy position, you're just using options to hedge the downside. It's a little bit easier to manage compared to a trader who just trades options to make money. Okay, so understand this. Diversification is mainly to spread the risk. I think this one quite straightforward. Okay, you don't want to put all eggs in one basket. So diversification is basically just to spread the risk. Okay, so different things, right? And I did not put that in terms of the buy and sell hedge, but buy and sell hedge is more specific to currency market trading. Okay, at the end of today's slide, I'm gonna give you an example so you understand what I meant by the buy and sell hedge. Okay, now let's do a little bit of a cost benefit analysis over here, right? Whenever you decide to do hedging, it's not a last minute thing, right? So what I mean by last minute is, sometimes you may execute a position first and then, it goes against you and then you don't want to cut loss and then you just decide to do a hedge. Okay, that approach will not work. Okay, because it's an emotional decision. It's not a well thought and well planned decision. Okay, so when you want to do hedging, you need to plan out your hedging management technique right at the start before you execute a position, right? You need to think of like, okay, if I'm going to go in now, okay, if it goes against me, how am I going to do my hedge, right? Or if it goes in profit, if I want to protect profit, how am I going to use a hedging technique to protect? It cannot be I enter first, then I think later, okay? Because if you enter first and you think later, it's going to be an emotional part and you're going to complicate the whole process because, you don't have a proper plan to kind of get in and get out of your hedge. Okay, so every time you you want to approach hedging, it needs to be well thought and well planned before even the position is being executed. Okay, so certain things to also consider over here, like cost benefit analysis, is basically your transaction costs, right? I mean, if today you're looking at FX, okay, brokers would have what we call a overnight fee, right, or a swap fee. So obviously, if you just kind of like hedge it for 3 years without resolving your position, then the swap fee may be very, very significant, right? It may eat into whatever potential profits you can get, right? If you're looking into maybe stock market, okay, certain platforms, certain brokers will have commission costs. Okay, so you need to factor those in as well. If you're looking into maybe futures market, right? Futures market would have an overnight kind of like bring forward, fee as well. Whenever the futures expire, brought forward, there's a certain fees, right? All these fees you need to actually understand that. Okay, different asset, different platform, slightly different fees, but consider those transaction costs, right? When you plan out your hedging. Okay, so then you want to determine, right, if today you want to get involved in a hedge, is all these fees making sense to you, right? I mean, again, as I mentioned, if you're gonna hedge out an FX position for 3 years, that doesn't make sense. Okay, simply because it's more of a short-term trading, and then if you just plan a hedge for 3 years duration, it defeats the whole purpose. Okay, so always think of all these things before you, I mean, not before you execute, but when you are planning a hedging strategy, these are things that you need to consider. All right. So with that said, okay, of course, at the front part, I can't give you very specific approach, because depending again on what's the purpose of your hedge, what instruments you're looking at. But over here at the front part, what I'm giving you is an idea, a basic understanding of it, giving you some insights so that if you're into specific instruments or asset, definitely you need to take it to the next step to go and study a bit more. Okay, so last part here, as we progress, I'm going to give you a little bit more example towards the FX side of things. How can we implement an effective hedging strategy, right? So you need to define again what's your objective, right? For me, as I'm giving you examples over here, I'm using it primarily for shorter term trading. Okay, so for me as a shorter term trading, my hedging is kind of like limiting my downside and potentially maximizing my profit instead of just cutting losses, right? So in terms of FX, the common risk management plan is you enter here, you have a stop loss there. If it hits your stop loss, you get out, you look at the next trade. When you implement a hedging technique based on the objective in the FX market, my objective here is, instead of me cutting loss, I just want to lock in that floating loss so that I control my downside. But then I'll look to resolve that position in the, at best net profit. But if I can't do it as a profit, then I'll at least look to get out at break even. Okay, so that's my objective when I approach the FX market and then use a hedging strategy, right? Okay, so over here, you can see you need to be clear, right? Examples are, are you looking to protect profits using hedging? Are you looking to limit your potential downside, or are you just looking to have a stable portfolio, right? So you need to be very clear on that. Okay, so for me, it's not to achieve stability, because again, in FX market, I'm looking at short term, right? I don't really need a kind of like stable equity, right? FX market is moving up and down quite fast. I'm not looking to just protect the profits, not so much in terms of my trading, but it's more towards the middle objective, right? Limit my potential losses. Instead of just cutting it, right? I look to limit that, manage that, and then get out in a favorable outcome. Okay, so over here, there are certain things you need to take note of, right? Like hedging ratios. What are some of the instruments you want to hedge? How much of your margin or capital you're going to be allocating to set aside for your hedge positions and things like that. Okay, so these are certain things, of course, you need to just consider. Okay, so let me jump into the examples of that. Okay, so give you an idea, a clearer idea and understanding of like how I use it. Okay. Okay, so all this pretty straightforward, right? Again, this is more about like, if you are starting a new strategy, okay, you need to then of course track, record, evaluate, okay, to see what are some of the improvements you can make about it, right? So this is the example that I use, right? Before we jump into that, right, I just want to re-emphasize, hedging does not mean it's a sure win, okay? It doesn't mean that you have zero losses or you don't have risk, okay? Hedging is basically just a management technique, okay? Hedging doesn't mean that there's no risk. There's risk involved. Hedging is a technique to manage trade and risk, right? It's not a strategy, okay? It's basically a management technique, okay? So this is some of my prerequisites before you even consider to do hedging, right? You need to be very clear in terms of your strategy, right? If today you don't have a trading strategy, you don't talk about hedging, okay? So what's a trading strategy? Essentially is how do you analyze the market? You know, how do you execute a trade? How do you determine at which point your trade is no longer valid? And then how you manage your risk, right? So the management of risk is actually the hedge strategy. But before you even reach that, again, you need to have your trading strategy. Okay, so you need to have the confidence in knowing how you can manage your risk and capital, and of course, the psychology behind it as well. Okay, so this one is also very important, right? As I mentioned just now, you need to plan out your hedge before you enter any trade. Okay, so the idea of this is it's not decide after you have a trade. Okay, this is part of your trading plan itself. Okay, I just want to make that very clear. Okay, so what I share with you over here in terms of FX, primarily, right? So this one here is not applicable directly to the stock market, but it's more towards the FX market. Okay, this hedging technique I'm using in the FX market is what we call a universal management technique, right? Quote unquote universal means doesn't really matter which strategy you use. The concept and the thought process behind this technique, where we apply in the FX market, can be applied to any strategy. Okay, but of course you need to then customize it a little bit according to the technique that very quick one. Okay, so let me break it down into the understanding of what builds up a trade that you're going to execute and you're going to manage, right? So the first step in before you take a trade, right, the first step is always about market analysis, right? You look at maybe fundamentals, you look at technical charts, for example, to determine the direction that you want to trade, whether is it buy, whether is it sell, or the direction is not clear, you stay away. Okay, once you've done your analysis, the next step is to execute a trade. Okay, like how are you going to get involved in it? What are some of the criteria and conditions you're going to look to get involved in the trade? And then the last step is management, right? So hedging comes in the third step. Okay, so management can be like putting a stop loss, or are you using a hedging? Are you using a trailing stops where you're going to look to get out? Okay, so all this are basically the management type. Okay, so analysis can be fundamental, can be technical. Execution is based on like how you're going to get involved in it, right? What strategy you use. Is it a candlestick formation? Is it a breakout trade? Is it a chart pattern? Etc. etc. Right? And then management is where you're going to get out if you're wrong, where you're going to get out if you're right. Are you going to trail stops? Are you going to use hedging, etc.? Okay, so basically you need to be clear on that. Okay, so let me give you a very, very simple example, right? Based on a very simple strategy based called support and resistance, or supply and demand. Okay, and why I use this as an example is to really give you the idea where everyone can understand. Okay, because right now I use a lot of Elliott wave analysis to kind of analyze the market and trade it. Okay, but Elliott wave itself is another study. So today's example, I just want to take a very simple concept, support resistance, apply hedging to it. Okay, so the idea here is if you're looking at support resistance, you're going to be buying at support, selling at resistance, right? Makes sense. You don't sell at support and buy resistance. Okay? So this is what we call a very, very simple trade plan. We identify support resistance. If the price goes to support, we look to buy. If the price goes to resistance, we look to sell. Okay, and with the understanding that especially in the FX market, we will not see price just keeps going up without any pullback. Generally in the FX market, price move in waves, right? Up, down, up, down, up, down. It can be generally trending up, it can be generally trending down, but basically it's going to move up and down, up and down, up and down, right? So we're basically capitalizing on all this. Okay, so very simple. Okay, let me give you some illustration over here, right? So basically we have a resistance at the top with a support at the bottom, right? So the simple strategy over here is if price keeps going up, tag the resistance, we're going to sell it there. Now, usually what you're going to do is you're going to have a stop loss at the top, right? Okay, which means if price breaks that resistance zone, you're going to get out because it's no longer resistance. But instead of putting a hard stop loss, okay, what we can do here is we can consider a buy hedge. Okay, what it means is that today you're going to sell it when it hits resistance. If it breaks that resistance and go to a certain price point like here, we don't have a cut loss. We don't close our sell, but we open a buy. Okay, now what this means is that if the price hits that buy hedge, you would have two positions running. One is a sell, one is a buy. Now, you would be essentially what you're doing over here, you're locking in that floating loss, right? So you're preventing your loss to go uncontrolled, right? You're preventing your loss to get bigger and bigger. But basically you're just locking it, right? So for example, if I say, okay, I want to risk $100 for this trade. Okay, so I'm going to calculate, based on this width where I'm going to sell and where my buy hedge is, I'm going to calculate my position size. Okay, and based on that, okay, I would say, okay, based on this width, my position size is XXX, and the maximum risk that I'm putting in is $100. Okay, so what this means is if price hits my sell and it doesn't go down, it keeps going up and it hits my buy, I would have two positions running and my floating drawdown will be locked at $100. Okay, so that's what it means. Now, when that happens, it doesn't matter whether the price keeps going higher or comes down. That $100 is gonna be locked in. Okay, $100 floating loss. Yeah, it's gonna be locked in, right? So it doesn't matter whether the price just keeps going up, up, up. I'm still just losing $100. Right? Why? Because my sell will keep losing, but my buy will keep profiting. Okay, so understand that thought process. Okay, so let's walk through some examples of how this would potentially develop into. Okay. So this is the thought process. So if the price comes out, we sell it there, right? We sold it there. And if let's say it comes down, which means our sell is profitable, then there's no need for a hedge, right? We don't really care about it. Okay. So in this case here, very straightforward, this trade play out. Okay. So the hedge is there, but we did not get into a hedge. Can follow, right? Okay, so we sold it there. Of course, we then buy at support, right? So imagine this comes down, it hits our take profit, we get out of a sell, and then we just buy. Okay, initiate a buy because this is support. Okay, so if we look to buy, then of course we want to look for price up, right? So I move forward a little bit. Same example over here, right? Now let's say this is resistance, support. Okay, so if let's say we buy here, then of course our take profit is there. Now let's say we want to sell it. Okay, we sell it as resistance, again same thing, buy hedge. If this thing goes up, never touch our hedge, come down, straightforward. So all these are not hedge. These are basically quite straightforward trades that play out, no need of management. Okay, now give you some example. What if the trade doesn't play out? So same thing, support we buy, sell hedge below, right? Instead of a stop loss, we put in a hedge position. In the event we buy, it doesn't go up, it comes down, we initiate a sell. Then if that happens, we have a buy, we have a sell concurrently running. Okay, so let's look at this example where the price actually came down, it touched our sell, and then it just basically float around. Okay, it did not really just go down immediately, it just float around there. Now in this case, right, we're actually locking in that loss, right? Because you can see buy, we are losing, sell, we are also losing. Okay, but we are locking in that losses. So just now I give you an example. If the maximum risk I'm prepared to hedge is $100, then this case here would be running $100 floating loss. Okay, so now that we are hedged, right, we then need to put in the implementation where how are we going to resolve the hedge, right? Resolving the hedge means you want to get out of this situation, at best profitable, if not break even. Okay, so what we can consider over here is based on just very simple support resistance. We can look at it in the perspective of price has broken support. Okay, so what we can do is we can look at if price goes up to our buy position, we can look to get out at buy trade at a break even, and then anticipate this will keep going down because price has broken support, now turns potential resistance, right? So if that plays out, means we get out at a buy, okay, at break even, and price starts to go down, our sell will make money. So you realize that instead of cutting my buy trade at a loss, okay, instead of realizing that loss, hedging gives me an opportunity to get out my buy at a break even, and then eventually maximize my profit if price starts to go in my favor to the downside. Okay. Now, of course, you need to do quite a bit of scenario planning, right? The idea is, what if you get out of the buy and then just this price just keeps going up, 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 up. Okay. So it's not something that you can just plug and play. Okay, but you need to have scenario planning, right? So the idea here is, if let's say I get out a break even and buy and then price just keeps going up, I need to then re-hedge myself. Can follow that thought process, right? Because I need to then ensure I need to control my drawdown, right? I need to control my floating loss. Okay. So if let's say if in the event I close my buy at break even and this just keeps going, I need to re-hedge myself. And then I'll look at the next area in terms of, like, if price goes up to this resistance, maybe I'll close my buy in profit and then look to resolve that sell, right? So we'll move a little bit into that in a while, right? But that's from here, that's the thought process. Okay. So as I mentioned, right, this is an opportunity to get out at break even, and then you just profit from the sell trade, right? Quite straightforward. Okay. Now, in the event, okay, let's just say I did not manage to get out my buy at break even, and the price just kept falling, right? So at this point in time, I have a buy here, and price has actually tapped the next level of support. So how do I mitigate? How do I approach this? Is I'm going to close my sell, okay, in profit, okay, which means this was initially $100. If this drops all the way here, my floating is still $100 because my sell is profit, my buy is loss. But at this price point here, I'm going to close that sell, lock in, and realize whatever profits I have. Okay, but then my buy is still running. Okay, so at this point in time, my floating losses is going to be bigger because I've already closed off my sell. But my capital has already increased, right? Because I've already realized the profit from my sell trade. Now, in the event that, I don't want to I really want to just realize that loss, I can close everything here, and I basically just lose $100, right? Why? Because I've made this profit here, I'll make this loss here. Net is still $100, right? So the beauty of hedge, the first thing here to consider is, at any point in time, if you don't want to hedge it anymore, you don't want to resolve it anymore, you just want to realize that loss, you can do that because you have already locked in that $100. Okay, that's already pre-calculated based on the position sizing and things like that, right? So that's one way to just resolve everything. Realize your loss, close everything. Now, if let's say you want to resolve this in a net profitable outcome, then what I do here is I do a little bit of a dollar cost average. Okay, so I have a buy position here. I close my sell. I look to buy again to add a second buy position because we're at support. Okay, and we are basing on a philosophy that forex market, it doesn't go in one direction all the time. It goes in waves, right? There's a good tendency it will bounce. Now, if I buy here and then I initiate a second buy here, basically to get break even on this two buy, assuming it's the same lot size, to keep things simple in this example, I just need price to come back somewhere in the middle. I can close this two buy at break even. And then my overall outcome here is I'll make money from my sell trade in my sell hedge, and then I break even in my two buy positions. Okay, that's assuming you have same lot size, right? Of course, the more advanced technique over here is you go and calculate another position size here. Maybe this position size is slightly bigger than this. It's even easier to resolve. Okay, but for example's sake, we keep it as same position sizing. Right. So in this event, you can see again, price tends to be moving in wave, right? Down, up, then maybe this will keep going down. But the idea here is we have this opportunity, just close the buy, break even, close, resolve everything. Okay. So at this point in time, you realize that, hey, I'm wrong in my initial buy, but the overall outcome by using this management technique, I'm actually profiting even if I'm wrong in my buy. Okay. Now, don't get me wrong, it's not a 100% thing. Okay, it's just a management technique to help us, instead of just cutting loss, to manage the drawdown and then look for ways to resolve it in the net profitable outcome. Okay, so that's one example here. Now, let's say at this point we close off everything. We look at the market again. Okay, we have resistance here. We have support at bottom. If price comes down, we buy. If price goes up, we sell. Straightforward. Okay, rinse and repeat. Okay, and of course, a sell here means we have a buy hedge at the top. A buy here means we have a sell hedge at the bottom. Now, moving forward a little bit, right? Price comes down, it tags our buy. Great, we got involved in it. We have a sell hedge below. If price breaks through that sell hedge, we will then get involved in the sell trade. Okay, So what happened next is, of course, price just keeps going down. It tagged our sell. Okay, so again, it comes back to this scenario where we have a buy, we have a sell, we lock in $100 loss. If price comes back up, we can choose to close the buy at break even and look for it to continue down to profit from the sell. Okay, it's basically same logic. You just rinse and repeat. Okay, so in this case here, the market came back up. We have this opportunity to close the buy at a break even and then look to write it down, right? Same concept. If close the buy at break even and this keeps going up, you need to look for ways to rehatch the sell position. Okay, so the thought process is quite similar. Now, in this case here, the market continued down, right? So this is buy. This is where we managed to have the opportunity to buy. But if let's say we didn't close and this keep coming down, okay, then what happened here is same thing. We'll close the sell, we look to buy it again. Okay, and then we have two buys. Net we look to get out at break even, halfway point. Okay, then we profited from a sell, and then we'll look to break even from our buy trade, right? So in this case here, didn't happen. Okay, so I want to show you like this can happen, right? It's not like always ideal situation. So in this case here, we have this buy. We did not manage to close it because it didn't come halfway point. We close our sell. We make some money from there. We have our second buy, and then right now it doesn't go in our favor. It tags our hedge again. Now, because we have two buy position, this hedge here needs to be of equal lot size and sizing of the two buy, right? Why? The logic here is if it goes against me, I want to lock in my floating loss. So give you an example, if this is like one lot, this is one lot, then my sell hedge becomes two lot. Okay, so this happens from time to time, right? So what you need to understand like what's the worst case scenario, how much you're planning for it, right? What's the worst risk, the biggest risk that you're prepared to take. Okay, so in this case here, we're hedged, right? So the whole thing repeats. Price goes down to a next level of support. We close that hedge. We initiate another buy, right? So this is where we get a little bit of a dollar cost averaging. Okay, but take note that as this is coming down, we have realized some capital gains in terms of the sell profit. Okay, we do have floating losses, but this floating losses is basically $100 here, $100 here. If you factor in your realized profit, okay, so it's not like out of control. Okay, because at this point in time, if you close off all trades, you just close everything, you lose $200. Can follow me, right? Because this is $100 risk, this is $100 risk. You close off everything, you lose $200. So it's in a very, very controlled environment. So if you decide to rinse and repeat support, we buy again. Okay, so if today we have buy here, buy here, buy here, assuming it's the same lot size, to break even from all the buy, we need it to come back in the middle. Okay, now again, price move in waves. It's not always going to be trending in one direction, right? So in this case here, fast forward a little bit, we get out on buy and break even. So net, we actually made two profitable sell trade. We get out of three buy at break even. So again, what happened here is we're in the wrong direction, but we did not realize any losses. We still be able to make money out of it. Okay, so the context over here, you realize, right? Looking back, the example that we're doing is we're buying when the market is in a downtrend, right? Which, of course, if your analysis has done a good job, you probably wouldn't put yourself in that place, right? But again, it's nothing's 100%. Okay, so in the event that your analysis and your execution is wrong, hedging can come in to help you kind of like maximize the potential over there. Okay, so we are generally buying in a downtrend, but overall, instead of like taking losses from our buy, okay, we actually got up break evens on our buy while managing the drawdown and profiting from the sell. Okay, so net, you can see, right, the outcome is we did not take any realized losses in our capital that are drawdowns, but we managed to grow our capital while maintaining that drawdown. Okay, so that's an example in the context of hedging, right? Of course, as I mentioned, it's not going to be always very ideal. Okay, you need to really practice it, I would say, right? And then at the same time, understand what's the worst case scenario. Okay, cool. Okay, so those are that example is just based on a very simple strategy of a support resistance. Okay, and I use that simple strategy to implement a hedging. Now, if today your strategy is maybe not support resistance, maybe your strategy is like moving average, etc. Okay, then of course the implementation of hedging, the principle may be the same, but how you're gonna implement that might be different, okay? Because you need to then determine like at what point you're going to close your hedge and initiate the second position on dollar cost averaging and things like that. Okay, so the thought process and principle is similar, but depending on your trading strategy, you need to customize it to that. Cool, huh? Okay, so I do see a couple of questions over here. Okay, so I'll pass the time back to the moderator first, and then I think later on we'll have the Q&A segment. Right, so I see over here, yeah. So you select a few questions and then we'll answer during Q&A. Right, so with that, I hope kind of today's presentation give you an idea about what hedging is, okay, how you can actually use this management technique if it fits into your personal style, to complement it into whatever trades or investment that you're looking into. Okay, but the key, of course, is you need to understand a little bit more. Today is just an introductory to give you an idea that this is possible. You need to go and study a little bit more and then, of course, practice it, okay, before really implementing it full scale in your own trading, okay, or even in your investing. Yeah. So with that, I'm going to pass the time back to the moderator.
All right. Thank you, Kayong, for the insightful sharing about the hedging. So for everyone else, remember to log into your MQ account so that you can chat with us as we will start our Q&A session very soon. So once again, just to share about VC Plus, they are having a $100 welcome credit campaign. So it's simple. You just open a trading account, deposit $500, and then you get the $100 for free as a welcome credit bonus. The campaign ends on 30th June in 3 days of time. So if you are interested in this $100 for free, you can scan the QR code to open a trading account, or you can find the links inside the chat box to learn more about it. And they are having a trading contest, and the price includes $250 and up to highest $1,000. So once again, if you're interested, scan the QR code or find the links in our chat box to learn more. And about the trading contest, they are using virtual credit, a virtual account, so no real cash are involved to win our prizes. For more terms and conditions, you can PM their support team to know more. And for MQ members, remember you can get a 300 MQ points as our check-in reward for today's webinar. Once again, 3 steps. First step is screenshot any part of this webinar. Second step, find the quiz email inside your email inbox. Third step, answer the simple quiz and then upload the screenshot. Then you are able to redeem your 300 MQ points. Remember, if you want to receive the quiz email, you will have to register for the webinar first. So as I said, we are going to have a Q&A session after Kayong sharing after this. So followed by a mysterious gift session. And in the mysterious gift session, we'll be giving out gifts worth up to 249 ringgit. So make sure you stay until the end to grab your chance to win our attractive gifts. So Kayong, let's start our Q&A session. The first question is from Zach T74. Here, the question is about, are there any notable trends or advancement in hedging techniques that individuals should be aware of?
Okay, good. I think I see that question as well. I okay, just to understand that question correctly, like
Kayong,
when
before that, I think your camera is off.
Oh, okay. All right. So notable trends and advancement in hedging technique. Again, the idea is there is no one size fits all. Just like a trading or investment strategy, right? There is no like the best strategy out there. There's no such thing as like the best hedging technique. Okay. Again, how aggressive you're gonna hedge out your positions. How are you going to use it based on different contexts of trading or investment, is something that you need to actually design to cater for you as an individual, right? Based on your style, based on your character, your personality. It's not something that it's only good or there's only advantage, right? Again, in trading investing, every decisions that we make is always a balance of skill, right? You have advantages of it, you also have downside of it. The thing about hedging here, of course, the benefits we have illustrated just now, but you also need to consider the fact that what if, in terms of FX, right? What if first hedge, second hedge, third hedge did not happen, and the market starts to really trend very strongly, and maybe you're looking at a smaller time frame, okay? Those are things that you also need to factor in, right? How many layers of hedge can you really emotionally control? Okay. So these are things that, again, as you start to practice, if you want to, apply this into your trading or investment, as you start to practice, you will encounter a lot of all these things where you can start to improve and add into your hedging plan. Okay. So this is something that I would say, in terms of like advancement, improvement, what you should take note. You always start small, right? Start with a simple concept, start practicing, start applying, and then you keep working on it, right? There's no point thinking about all the things and then did not start a single step. Okay. Because in trading and investing, there's a lot of trial and error, right? You need to go and figure out, is this technique fits you? Does this technique work for you? Because one technique that worked for one trader doesn't necessarily mean that it's going to be very effective for another trader. So that's my thought, right? That's my suggestion, is start practicing. Okay, you may start off practicing maybe even in a demo account if you're not comfortable with a small account. Okay? Start with a demo account, practice it, and then as you practice, you encounter different scenarios. That's where you kind of strengthen your entire plan. Okay, so this approach is not only for hedging, but if you are developing a strategy, developing your execution method, it's the same approach. You practice and then you enhance it as you progress. Right. So that's my answer to that.
So basically, start small and then practice makes perfect.
Yeah.
Okay, so and again, if you guys want to practice, actually VC Plus has a virtual account for you to use. So you can sign up or find the links inside the chat box for it. Okay, so we move on to the second question. Is from Jardin98. The question is about, since hedging involves taking opposite position on an asset, can you explain how traders can earn if they keep on taking both directions when trading?
Yeah. Okay. So I think we can explain that in the example, right? Where one way of how I resolve a trade is to close off the, let's say we buy and then we have a sell. The market comes down, we close off the sell and profit, and then we look to mitigate the buy by DCA, right? Dollar cost averaging. That's one method. Okay. That's very specific in the FX market that I implement. But of course, if today you are using, in the stock market, you're using options and things like that, the technique to resolve it may be slightly different. Okay, depending again on how you execute your options, positions, etc. Right. So when we talk about hedging, right, that's why I keep emphasizing it's not a sure win thing. Hedging primary goal is to first control your potential loss, right? Limit your downside. Okay. Once you have done that, right, because that's the primary goal of hedging, the next phase is, of course, how do you resolve everything in a favorable outcome. Okay, so your question on like how to get out and how to resolve, again, there's many techniques. I don't use hedging in stock market. I use primarily in my FX trading. So my style of getting out and resolving trades, basically I've shared with you just now, right? We close off the profitable one, we look to dollar cost average in the second position, and then resolve that two positions in the net break even outcome. Yeah.
All right, thanks for clearing the air. So we move on to the last question for the webinar. It's from TCY1011. Question is about, what are the potential risks and drawbacks associated with hedging, and how can they be mitigated?
Okay. I think the primary risk here is, if I'm putting the case in terms of like the way I use it, right? The drawback or the biggest risk here is if the market trends very, very long. Okay. It basically means that if today we buy and then the market drops, okay, we open the sell hedge, it drops. We close the sell, we initiate a buy, it doesn't bounce, it keeps dropping. Okay. And case in point is if today you're trading on a smaller time frame, that may happen, right? Because if you look at maybe 15-minute chart, the market may really trends quite significantly. So how to mitigate that is one way to look into is maybe move it into a higher time frame, right? So maybe if you're looking at smaller time frame, don't be too aggressive in hedging. You may want to trade in a small position, but if you're doing on a higher time frame, the market may move maybe a couple of hundred pips, but it's never going to keep going in one direction without any kind of a pullback. Okay. There is the high chance that after a certain move, the market will pull back. Okay. So overall, some factors to consider to help you mitigate a little bit of all this risk is what time frame you are looking, right? How aggressive are you positioning your trades, as well as your hedge? What is your lot size? Okay, because of course today, as I mentioned, right, it's not about not cutting loss, but the idea is you need to factor in every hedge. What is your floating loss that you're comfortable with? So you can of course put in like every position I get in, I'm risking 2%. Okay, what it means is that if your position is wrong, you hedge it, you don't cut loss, but that floating loss is just 2%. Okay, which means at any point in time you feel that, well, it's getting very complicated, I don't want to resolve it anymore, you can actually just close that 2 position and then you realize your 2% loss, right? I mean, that is something that you're prepared to do anyway, right? You're prepared to lose or risk 2%. Okay, so that's also very important, right? It's not about you just enter a very big position and then you look to make money out of it. Okay, you still need to have that risk management plan in place. Now, in the worst case scenario, let's say you have 5 layers stack, okay, which is huge, right? 5 layer stacks. Basically, that means you have like 2%, 2%, 2%, like 10% of floating loss. Okay, so you need to then factor in, okay, are you still comfortable with it? If not, then how do you pre-plan in the event of a worst case scenario? Okay, so are you gonna cut, stop hedging and just basically cut it before it reach 10% drawdown and things like that? Okay. So these are some of the drawbacks, or I would say not so much of a drawback, but more of like factors you need to consider as you're designing your hedge, right? And as I mentioned, the only way you will encounter and be able to really enhance your plan based on all these factors is to really practice it in the market. Because again, I'm using it on 4 hour versus a trader who maybe use this hedging technique to apply on a 15-minute time frame. The factors that needs to be considered is very different. Okay, because 15-minute, again, a lot of elements are moving the market. 4 hour, we're looking at the bigger scheme of things. You can say it's less volatile as compared on the smaller time frame, right? So things that we look into may be slightly different as well. Okay, so I hope kind of give you an idea. Like again, I think the most important thing is don't have that thought process or mindset that hedging equals sure win. Okay, because if you want to implement hedging to reach that sure win, no risk outcome, the starting point is wrong. Okay, and you're probably not going to achieve that anyway. Yeah.
All right, thank you, Kyle, for the very insightful and detailed answer for it. So once again, thank you, Kyle, for this insightful session about hedging. And that sums up for our session today about maximizing your profits with hedging. I believe all of you have learned a lot today from Kyle to become a better trader. And then we will now move on to our mysterious gift session. So in this mysterious gift session, we'll be showing question and answer options on the screen. You just need to send out the answer that you think is correct, and we will be giving out gifts to the first 2 persons who answered each questions correctly. Now, to get ready, remember you need to log in your MQ ID first to chat with us inside the chat box and send the answer for us. And if you have won this session before, we'll automatically pass the chance to another person so that everyone gets a chance. So if everyone's ready, I will now start the mysterious gift session for the webinar. All right, the first question, what is hedging? Which is a very simple question for it. So is the answer A, a type of fundamental analysis? Or is it going to be B, a type of stop loss strategy? Or even C, D? Yeah, so most of you answered it correct. All right, the correct answer is C. Hedging is a type of risk management strategy. And give us a moment while we collect the first two winners. And for winners, remember that you need to send us your contact details inside the Google form so that we can actually arrange the gifts for you after the webinar ends. So the first two winners are Hui68 and Yuk Long. Remember, send us your contact details in the Google form. Now move on to the second question is which instruments below are often used in hedging? Is it going to be A, futures and option contracts? Or is it B, retail trader contracts, gold CFD, or even US dollar? All right, so for the second question's answer is A, futures and options contracts. So let me see who are the first two winners. Okay, congratulations. The first two winners are Ng Pui Hao and QK0509. Congratulations on winning it. Remember, send us your details inside the Google form. All right, so if everyone's ready, we will now move on to the final question for our Mysterious Gift session in this webinar. What are the things to be considered when in cost-benefit analysis step when you hedge? Well, I see some of you are quite fast with it. Any more answers? All right. So I believe I saw the correct answers already. And the correct answer for the last question is D, transaction cost. And the first two person who got it correct is Robert123 and Easy Trade. So once again, congratulations to the 6 of you on winning in our mystery gift session. Remember, use the Google link in the chat box and send us your contact details. Then afterwards, we can arrange the gifts for you. That sums up for our mystery gift session. And once again, just like to mention that VC Plus is currently running a trading contest starting from 1st June until 30th June. So basically only left 30 days for it. The highest price goes up to 1,000 US dollars. And the best part is it's a virtual contest, which means that you can use fake credits to participate in it. So if you are interested, even you want to try out Kayong strategy in a virtual account, now is the best chance for it. So if you are interested, you can scan the QR code or find the links in our chat box to open a free trading account and participate in it. Now, MQ Trader will be organizing webinars at least once every month. We also sometimes organize giveaway campaigns from time to time as well. So remember to like and follow us on Facebook, Instagram, or even i3 Investor if you are interested in our future webinars and campaigns. Once again, a very big thank you to all of you who participated in our webinar this afternoon. Thank you for staying through, and I sincerely hope all of you have learned something useful today. I will now turn off the camera, but still keep the webinar live for around a few minutes so that all of you can refer back to the links or QR code if you are interested in any of the service. Once again, thank you all of you for making this webinar a great success. I'm Robin from MQ Trader, and I wish all of you have a great day ahead.
Thanks for watching.